We now have a panel on digital finance. India is at the forefront of a digital revolution, with it being the world's largest open data market and second largest internet subscriptions market. What steps can be taken to make digital financial inclusion more effective and inclusive? How can India collaborate with other nations to create inclusive societies? The panelists for this discussion are Esselina Macome, Chief Executive Officer of Financial Sector Deepening Mozambique and former Executive Director of Payment Systems at the Central Bank of Mozambique, Shilpa Kumar, who is a partner at Omidyar Network India, Malvika Raghavan, who is advisor and former head of the Future of Finance Initiative at Dwara Research, and Sultan Meghji, Chief Executive Officer and co-founder of NeoCova and non-resident scholar Cyber Policy Initiative at the Carnegie Endowment for International Peace. This discussion will be moderated by Suyash Rai, Fellow at Carnegie, India. Welcome all.
Hello and welcome to this discussion on how digital finance can help India and Africa make progress towards complete financial inclusion. I'm joined by four esteemed panelists who have experience of working in India or Africa. Some have experience of working in both these places. To help frame this discussion, I thought I would spend some time, a few minutes, to discuss what we mean by financial inclusion and what are the opportunities in digital finance that could help in financial inclusion. So the way I think about it, financial inclusion is a three-dimensional challenge. The first dimension is about reaching the people who don't have any access to formal financial services with at least some financial service. So it could be a bank account, it could be a mobile wallet, it could be a loan, but it's basically about the first point of entry for these people into financial system. But that's just a very basic, one-dimensional definition of financial inclusion. The second dimension is about reaching the breadth of financial access. So if a person has a bank account or has taken a loan from a formal financial service provider, how do we get more financial services that they need, that are suitable for them, to these people? So, for example, if I have a bank account, how do I get access to insurance? How do I get access to pension products and so on and so forth? So this is the second dimension. So if you have some access to financial services, say a bank account and a loan, if you get more of these services which you need and you're suitable for, then you can say that there is a progress in the second dimension of financial inclusion has been achieved. And the third dimension, which in my view is perhaps the most important dimension, is the dimension of quality of financial access. So, and this quality is usually experienced while using the financial service over a period of time. So this is about how convenient it is to use the financial service that you have access to. How secure and reliable is the financial service provider who is giving you this service? How much dignity do you get as a consumer while using the financial service? And these kind of issues. Now, while the first and second dimensions are relatively easy to measure and we understand them, and often what gets measured gets done. So we see a lot of data on how many people have transacted, how many people have some access to financial services. The third dimension about quality, about convenience, reliability, things of dignity are often not easy to measure and therefore are often lost in the discourse on financial inclusion. But when we talk about financial inclusion, we need to think about all the three, especially because in financial services, quality is very important because if you have poor quality financial access, then it is sometimes worse than having no financial access at all because it could do harm. For example, suppose you have an insurance product in which you are giving premium year after year, and when the time for the claim comes, you figure out that it was not the right product for you. It was not suitable for the kind of risk that you were facing. So that's worse than having no financial access because then you would not have at least paid the premium that you did pay for the years. So all the three dimensions are important. And if I look at the last few years, especially in India and Africa, we have made quite a bit of progress on the first dimension of financial access. So in India, especially, and in some countries in Africa, especially countries like Kenya and South Africa, we have seen progress on opening of bank accounts, opening of mobile wallets. Payment access has improved significantly. Even in on credit front, for example, by expansion of microfinance institutions, which are formal financial institutions, you've seen access to credit improve significantly. It's not quite universal, but it's improved quite a bit over the last few years. And and a lot of this has been enabled by digital technologies. So expansion of mobile telephony has been a key part of it. The reduction in the cost of accessing the client through point of service devices and all, they have all been an important part of it. So digital technologies in finance is not a new story. So it's been going on for a while. Why we're discussing it now and why it's become more important is because of this a bunch of new promises that have emerged from the technology industry and from the side of engineers and technologists. And the promises they're making is that the financial service design and delivery itself is going to go through major changes in the coming years because of what is happening on the technology front. So, for example, the people who do innovations in artificial intelligence are saying that you can get better predictions about creditworthiness and risk based on artificial intelligence engines. People in the cryptography community say that the advances in cryptography have made much more secure the process of doing transactions online. So that will help in building trust. People who are enthusiasts for distributed ledgers say that the promises there are the most ambitious in many ways because they claim that there's going to be a huge disruption in the way not just financial services are provided, banking is done, but even the currency is managed. So there are many such promises that are going around. Many of them are early stages of adaptation, and we need to see how these promises pan out. So, but overall, there seems to be an opportunity there to find new ways to get financial access expanded along the three dimensions. So you could improve the quality, you could improve the breadth, and you could and at least quickly touch upon some financial access to more people who didn't have access earlier. But there are also risks. So digital finance, like any new innovation, comes with opportunities and risks both. And for regulators, for policymakers, it's important to manage these risks to be able to figure out how to move forward quickly. So, and we've seen mixed responses from regulators, treasuries to these innovations. So some of them have been more supportive, but they've all basically taken varying degrees of precautions to make sure that the progress is not coming at a very high cost for people who are actually using it now, but may suffer later if the precautions are not taken. So these are the kind of things that we'll talk about today. How can these new opportunities help expand financial access across the three dimensions that we talked about? But we should also be mindful that we're having this discussion in the middle of a global pandemic, and the pandemic is having a huge impact on economies all over the world. And at least from the early data that is available, it seems that the people who are most vulnerable are also most badly hit by the pandemic. And these people are also, by definition, the financial exclusion problem is greatest in the people who are already vulnerable economically or otherwise. So how is this pandemic going to affect this pursuit of financial inclusion? Is digital finance helpful in solving some of these problems, or is this pandemic going to derail these efforts for a few years? We should perhaps talk about this also. So with this background, I would like to invite my fellow panelists to give their opening remarks for 3 to 5 minutes each. And I would like to pose a broad question to them. how do they see digital finance as shaping the story of financial inclusion from their respective vantage points over the next few years? What are the opportunities? What are the challenges? What are the risks that need to be managed? First, I would like to come to Dr. Esselina Macome to give her opening remarks.
Thank you for this introduction to our panel. First of all, I have also to thanks for this invitation. Going to our topic of the panel, really the way that the financial inclusion have been moving since when the movement started some maybe 10, 15 years ago up to now, we have been seeing that there is a growing in terms of what we understand in financial inclusion. You state clearly the definition of financial inclusion. When we start, mostly the important was the first stage, the access. But now we do understand that it's not enough just to talk about access, not to talk about use, but the quality. And I want to add here in the quality. In the quality, it is important not just to see how the quality of digital financial service, of the financial services that we are providing to the people, how better respond to what they need, but in the end of the day, how they respond to their quality of life. And I want to bring also in our discussion that we need to see the digital financial or financial inclusion as part of contributor to the SDG, to the Sustainable Development Goals. We have to ask ourselves what we are doing in the financial inclusion space, to what extent it's contributing to the quality of life of the people, and if it's contributing to which SDG what are we doing? And if we can make this kind of link, then we will really starting to understand better the third dimension that you very well highlighted. So what I want to say in the beginning, that there is a need to bring financial inclusion to the real life, to the real economy, has to have a meaning to the people, not just for financial service provider, have a bank account and they have a money. What does it mean to the life of people? When we reach that position, really, then financial inclusion will be reaching that third level that we're talking about. And I do believe that in that time, then it will be also easy for us to measure, as you say, that it's not easy to measure how this third dimension is reflecting to us, because it's reflecting to the people, it's touching the life of the people. So my question or my point here is that financial inclusion needs to change the life of people for better. If we manage that one, so then we will be really having financial inclusion, and will be also inclusion. Going direct to your question about the digital financial service and financial inclusion, how digital financial service is shaping financial inclusion. We are living in the digital era, and really the digital era is bringing us good things, but also some challenge. Good things that even today with COVID, that this conference was supposed to be presential, we are now having our panel because of technology that is provided. And financial inclusion was not also a sector that was not shaped. Maybe in the finances where technology was mostly shaped during this last year. I want here to bring the example that is well known, particularly in Africa, the M-Pesa case. When M-Pesa case started, most of us, we didn't understand, but we are lucky that the governor of Central Bank of Kenya was saying, no, don't stop because you don't have a regulation. Let's see what kind of product is coming. And really now is something that all of us, we are now proud in the world to have that kind of service that is benefiting people that in the last mile, that before they were receiving money via bus or by friends traveling, and now we can have transfer of money electronically and using the mobile phone that was already there, transforming. I used to say that it's not just a phone, is now more than a phone, because via my cell phone, I can do my banking, I can do my insurance, I can do a lot, even I can do my conference. I can do a lot of things. So maybe the name sometimes will have to change. That is no more mobile cell phone, it has to have another name. I want also here to share with you what we are doing here in Africa, and bringing maybe some experience in terms of what the FSD financial sector deepening is doing also. I can later on talk, but because we want to talk about the digital financial service shaping financial inclusion, there is a survey that we used to do called FinScope survey, financial consumer survey. And it is interesting to see, for instance, I will bring the example of Mozambique, to see that the FinScope that we did last year is showing us that the level of exclusion or the level of inclusion has improved in terms of access, in terms of use. And if we ask what sector is contributing for that one, it is interesting to see in the case of Mozambique that the contributor come from the mobile money. The mobile money contributes more than 50% for our level of financial inclusion at now. So it has been increasing in these last 5 years about 46%, that one. But when we check in terms of the bank, how the bank has improved, it was just 1%. So meaning that the majority of people that we are now bringing to financial inclusion, they are coming to that space, not via traditional banking service, but via those new technology. So for me, I cannot see financial inclusion without digital financial service. What we do need to do in order to make the digital financial service in service of financial inclusion and in service of improving the quality of life, as I was saying, that the financial inclusion in the end of the day is what does mean to my life. So for me, there is here a big opportunity. And another point that I want to bring here is that when you check in terms of gender, usual in our country, I don't know how it is in India, I didn't check the statistics, most women are behind in terms of financial inclusion. And it was interesting to see in the case of Mozambique that our data is saying that the gender, the women are the one that are contributing more for the reduction of the exclusion. Although they continue being behind, but their participation was higher. And their participation was higher via digital financial service, was not via traditional bank. They say that it was interesting when we ask why you are not going to the bank, they say the banks don't understand us. Don't understand us, for me, has different explanation. Might mean that don't understand us because they are not designing products that are responding to us, to what those women they require. And now it's coming the issue that with the digital financial service, yes, it's a good channel, it's a good opportunity, but will be in service of those billion that we are talking here today if the providers that are producing service and products that are responding the needs of the target group. We are not no more in the time that we are generalizing a product for anyone. We need to understand what is the needs, and the needs for sure is related to the status of his or her quality of life, and the service should be responding for that one. If you accept, I think there is no doubt that the digital financial service has a big role to play in financial inclusion, but also in the economy. There is no doubt that all of our country now they are discussing the digital transformation, the digital economy, because all of us will understand that we have now technology is playing a role, and we have to take the major benefits of this new tool that we have in order to help our people, in order to improve, and in order to contribute for a society where all we feel contribute, and where we feel that no one has left behind, all of us, we are pushing together. I can stop here and we can continue our discussion because I can share what we're doing at the FSD network and different FSD, but I think now just to bring some words for our starting the discussion, if you allow me, I stop at this moment. Thank you very much.
Thank you, Dr. Macome. That's very helpful. And I think one thing that India shares with Mozambique is this the fact that women have been leaders in getting financial access because of two technologies. One, of course, is mobile and digital, but the other technology is the human technology of group-based lending. So, in India, there was a big expansion in credit in rural areas because of group-based lending, joint liability groups, self-help groups. They're all basically women, most of them. There are a few men's groups also. And that was one of the key technologies I would put, not digital technology, but human technology through which credit could get to rural areas. Otherwise, it was very difficult for credit access, especially low-income households. Shilpa, I want to come to you next and for your opening remarks, please.
Yeah, thanks, Ayash. And I agree with Esselina that, essentially it's about making life better. And I would say finance in terms of making life better, one can think of it in various ways. One is, of course, safety net for people, safety nets for the vulnerable. But then again, it's also about how do you save, how do you invest, how do you insure yourself, and how do you borrow to actually get capital to make life better. And I want to share that I've seen this from the inside in the financial services space for the last 30 years. And when I look back and I see what India has achieved in terms of at the first stage, I would say it was really just about maybe the first 500 million people in the country. And there was just enormous push and momentum that came out of technology and digitization as the country kind of moved towards more saving, more better ways of investment, better ways of borrowing, and that really drove the economic growth in the country. But I think when you look at beyond that first 500 million, it really did seem like while finance had digital finance had helped make further inroads into inclusion process, it was maybe a glass half full and a glass half empty, both. And I want to just start off by actually talking about one part of those 3 or 4 ways of making life better, and which is really the whole issue to do with safety nets. I must share with you at Umhidyar, we actually do a kind of, consumer survey, state of Aadhaar report that we publish. It's a very extensive report. We look at more than 160,000 people covered. And I think when you look at, what the consumer has to say in terms of simply what does this whole coming together of the financial infrastructure mean? Where you've got, identity, bank account, and the ability to, transfer money directly to a person in the country. I think the data is, quite interesting. I mean, for the first thing, 95% of people who actually, were surveyed, and these are all vulnerable people, they kind of said that, look, with Aadhaar, we actually have an ability to avail of, transfers. Um, the other thing that, really they said is most of them actually depended on it and felt like more than 80% of people actually felt their ability to access governmental schemes and payments had really improved with this digital, identity and payment system. I think the real test for all of this came during COVID and the pandemic, when you saw that bulk of people, in fact, 50% of people whom we surveyed had lost primary job earner had lost income. Another 20 odd percent had actually seen decrease in income. And at this point, when you're in lockdown and there's a need for financial support, I think it's quite amazing that leakage free you were able to reach some form of payment to more than 80% of people who were surveyed. I think that really says something for the glass half full, because to reach such a large population at scale, leakage free, I think that's what digital finance has enabled. But at the same time, when we look at the glass half empty, that's also something to be really thought about, because when you look at the 5% of people who don't have Aadhaar, and therefore don't have this trusted identity, and the fact that they're not able to access even a safety net, for a country our size, that's a large number. Um, if you look at the fact that even for payments made, 50% of people are not able to take, the payment that has been sent to their bank account out. It means that, okay, you've got it up to a stage, but it has not moved out of that. And I think if you combine both these things, what you get is classic last mile problem, which is that, okay, great momentum, lots of good things have happened, but the last mile is always the trickiest mile. And I want to actually talk about two things in relation to this last mile problem. Look, I come from a business background, and therefore for me it's always about how do you improve customer experience, only if you know what the customer is saying. And therefore, I would say that really the last mile needs very good grievance redressal and feedback mechanism pickup, so that we can see what are those last mile, issues which we can kind of work one by one to resolve. I think that's the first. I think the second is, as you reach the last mile, the kind of partners and entrepreneurs you need to traverse the last mile become very different. It could be a combination of government, it could be for-profit entrepreneurs, it could be social entrepreneurs. And I think you need all three of them in equal measure, because again, in the last mile, it's about how do you reach the most excluded. Maybe you need it to be in vernacular languages. Maybe you need someone who can have the incentive to make that last mile journey and, really get the last mile included. So to my mind, you need all kinds of creative capital to really get this going for the last mile. I'll conclude with looking at not just financial inclusion for safety nets, but maybe the point you made, Suyash, about financial inclusion for better savings, borrowings, insurance, and again, I think the journey there. Frankly, there's still a lot of room to really go forward. Payments is like a first step, but just like payments, we've reached in a sense the last mile. My hope would be that even for other parts of financial well-being, we will traverse this road and take it down to the last person. But more on that later. Would love to hear what other people on the panel have to say.
Thank you, Shilpa. I think this point about glass being half full or empty is an important one, because it depends on who is seeing it. If you see from the top, it looks full, because that's why you think that everything is digital now. You can do everything easily. But once you look below the surface, it seems like 50% kids don't have phones to do online classes. 50% of the payment didn't go to the live class person. So you didn't even think about these eventualities, and the human costs are quite significant. This rapid digitalization is a double-edged sword, and we need to be careful about what to count on it for. Like there are some things you can count on for. Okay, people are transacting with each other, but if government's urgent welfare delivery has to ride on it, then there should be a plan B where it's not working. It has to be. And I mean, it depends on those questions as well. Sultan, I'll come to you next for your opening remarks, please. A lot has been said, and I hope you'll bring a different perspective into it as from a practitioner of fintech.
Well, thank you. And let me say, coming after these two speakers, I feel like about half of what I would want to say has already been said better than I could. So That's wonderful. I think, getting a little more tactical on this in terms of some of the good parts and the bad parts on financial inclusion are important. First is, I cannot stress more strongly what's already been said about this hyper focus on digital. It is not a parallel path. It is not an add-on path. It is a replacement path. And as we look across the entire financial ecosystem, more and more of our core financial functions are becoming entirely digital functions, and we're seeing that not just on the newer side of things in the fintech ecosystem and M-Pesa and the digital wallets. And I really liked the highlight of the digital savings books. We saw some great work with that done in Tanzania over the last few years with AKDN. But now it is also a digital transformation journey of the legacy community financial institutions and central banking infrastructure. The vast majority of these institutions are using technology from the early 2000s or even into the 1990s. And as such, they're incredibly brittle. They're hard to interact with. At the human level, it's hard to get your money in and out. At the operational level, it becomes incredibly difficult to run efficient businesses. And at the end of the day, these are all businesses. So you have a huge issue there. The second thing, though, on the good side is across India and Africa, you have an absolutely fantastic digital supply chain. And for the last few decades, unbelievable progress has been made. And you see it in consumer access to certain aspects of financial services. This needs to extend and expand into things like artificial intelligence, which I'll get back to. The second area of expansion that we really need to see a little more energy put behind is moving from consumers into non-consumers. So moving into the small businesses, moving into the village businesses and the small city businesses. And this is an area where, we can't put enough energy. The ability to take an individual proprietorship that could then have a couple of employees that could then grow and build, having an ecosystem that lives both in the public sector and the private sector to support that in terms of digital financial services is a key function that we should be spending more energy on. Now, you can't talk about that without talking about regulatory evolution and innovation and regulation, of course. And that's an area where, it's some good and some bad. I will say, as someone who lives in deploying technology at scale like this, you see both on a daily basis. In some cases, you see wonderful regulatory communities that are open and embracing it, and Dr. Macome highlighted in Kenya some wonderful work there. But then you see the other side of that, and there is a digital knowledge gap that exists among certain circles that we really need to do more about, whether it's basic digital literacy in terms of the capabilities of technologies of today, or moving into larger, more interesting things like artificial intelligence and neuroelastic computing and quantum computing, and these things that are all coming very quickly. As we continue to push for this, the regulatory communities can't be isolated islands. And we see this across the world. We see a lot of communities where the regulators just live in their own little bubble and don't communicate with other regulators, don't communicate with the private sector. And that's a real challenge. And as policymakers, we need to put a little more energy into ensuring that, good successes in one bubble are communicated well and effectively into the other bubbles, and that these groups, work with each other. And in some cases, it can be even inside the same nation state. As someone who's sitting in the United States, we have, rough order of magnitude, 100 different financial regulatory bodies that you have to interact with at various points to do anything. And so even getting, them to talk to each other can occasionally be a challenge. Speaking a bit of a tangent on artificial intelligence, there's been a lot of discussion around its applications in consumer lending decisions. And that's one very specific use case that we really need to be very cautious about, right? Because traditional underwriting, traditional decision-making around consumer financial access is clearly not the right way to do things, because we wouldn't be having this conversation about financial inclusion if it was doing its job correctly. But there are a huge number of other use cases for artificial intelligence that are coming rapidly. Everything from money laundering to back office automation to analytics to predictive modeling of the balance sheets of everything from central banks down to a very small entity, a small company or an individual's, financial health. and getting the regulatory community to understand that these things are coming at an incredible pace, is important. I would highlight that a year ago, I was sitting with a number of central bankers, and they were talking hypothetically about one day having a fully automated AI to work on anti-money laundering and other payments fraud activity here. And in less than 8 months, they went from a hypothetical to deployed technology at scale. And that's not something many regulatory communities are prepared to deal with. I would say, though, that when we do talk about multinational regulatory issues, a big concern I have is around data localization. Having each country have its own rules that are not necessarily compatible with every other is going to be a challenge. The volume of cross-national payments activity is skyrocketing. It's not going to end. COVID has been a great accelerator of that, and there's a lot that we need to pay attention to there. I would also say that cyber risk is continuing to grow and expand in its issues. And for those that are most impacted by well-run digital financial inclusion programs, the individuals who need it the most, they are also at the highest risk. And whether or not it's simple things like account fraud or, more complicated, local issues, in their home, for example, these are huge issues that need to be addressed. We've seen a variety of bad behaviors and bad actors that we really need to jump in front of. I'll end by simply saying one of the other challenges that I think we as a community struggle with is having standardized metrics around how we understand the impact of these things at whether it's the individual, the community, the nation state level. It's very hard to judge the success or failure of many of our programs because we aren't thinking about how to measure the success or failure of them on the front end. And that to me is a huge issue because there have been unbelievable successes that hardly anyone knows about. And there have been huge failures that everyone knows about. And we really should, control that and make it a little more data-driven. And with that, I will stop. Thank you.
Thank you, Sultan. I guess this question of having metrics for success and regulatory comfort and understanding of these technologies are connected because I think the regulators ultimately end up holding the accountability if things go wrong. And they should. They're the ones appointed in public trust. And unless they are able to better understand how the technology is impacting actually the quality of life, the points that Dr. Macome and Shilpa also made, that there will be some disasters also that will be avoided because of the regulatory conservatism also. There will be, of course, very good things that will not happen. For example, the vaccine is getting delayed because regulators are sitting on approvals and maybe a few more people would have got the vaccine earlier. But maybe some bad vaccines will not get past the grade. Malavika, I want to come to you. Sorry to come to you last, but I know you're the best of the world, so I thought I'll take this as a given that I can do this to you. Please, with the opening remarks.
Sure. So more pressure on me to be entertaining, basically, by this point. But I'll try and take on the challenge after 3 excellent speakers. Thank you so much for having me here, Sir. I suppose what I thought would be helpful in terms of the story of digital financial inclusion in India that you were talking about is maybe what I'll do in my comments is just really look at where we are at this stage in the pandemic on the economic and the financial side, and then bring it into particular communities in the financial inclusion world that we care about. Because I think, when talk about inclusion at the highest level, you're just saying low-income households or low-income individuals. They have very, very specific disaggregated characteristics. And I think maybe that if we talk at a specific level, that might help think about what are some solutions to some concerns we're seeing on the ground. So to kick off kind of very quickly, I think everyone's been talking about this K-shaped recovery. I saw Geeta Gopinath at the beginning of this week talk about how it's going to be a big challenge, not just within countries in terms of, economies are rebounding, but the kind of haves are having more, and the have-nots are kind of getting stuck at a much worse than lower equilibrium situation. So this increase of inequality within countries, but also across countries, right? Richer countries are probably going to be better off because they export and kind of have digital services, but also better ability to access these services, as opposed to poorer countries who might have other kinds of infrastructural issues. Why does this connect with what we're talking about today? I think it's because mainly 2 big things for me, which is employment, and the other one is kind of digital access. Now, the issue is if you're having a K-shaped recovery, what we are seeing in India is that our employment numbers are better now. But then when you disaggregate that and say, look at specific categories of people, women haven't gone back into the labor force as much. And casual workers lost their jobs early on, and they've come back, but probably at worse labor conditions, perhaps at lower incomes. I mean, I think one thing we know is there's roughly each household is earning probably less than 20%. I've seen different numbers, but 20 to 25% less at this point in India than they were at the same time last year. And if you're talking about financial inclusion, that means every rupee counts that much more, right? So while we can talk about, kind of, I think for people like us on this, it's kind of a great innovative time. For a lot of people, actually, the infrastructure and the supply chain for finance has become increasingly critical. And I'll kind of get to some of what we've seen on the ground here. I guess the big picture with this K-shaped recovery is we also have to keep in mind that between March and May, no financial sector formal disbursements of credit was happening in India, right? But we also know there's been almost 100% increase in households borrowing. So then where's that borrowing coming from? Friends, family, informal sources. So I think, clearly the need is huge. There's a huge digital transformation which has been done, but I think there's actually a lot more we need to do in terms of reaching the people we need to reach. And especially when, there are certain populations who are going to have less to spend or may get left behind. So then the question is, how can we work with even lower incomes to provide a better quality and reach of service to help some of those smoothing effects? I guess the second point I want to talk about is about digital access. So while I think the first decade of digital inclusion in India is very much this kind of emancipatory narrative of that, put a phone in a person's house and you really set them free, you get over some of those traditional barriers to finance, like, length of time to get to a brick and mortar branch, social, stigma for lower income groups, and so on and so forth. I think actually what we're trying to see, interesting week to have this conversation, the National Family Health Survey results, which actually track our SDGs. So I know Esselina brought this up at the beginning, were released. And what we're seeing there again is that actually women in lower caste groups, especially women, their internet usage is actually lagging in pretty significant ways. So I think the headline there was that 46% of women in India had actually never been on the internet or answered that question that they hadn't, as opposed to over 65% of men. And I think this is something we've known for a while, that I think even a couple of years ago, I know that the gender gap as per GSMA and Findex and all of these surveys was something like 28% in India. And there's also a shout out to Dr. Leena Son, with whom I've been doing a bit of work on qualitative and quantitative reviews, basically show at a headline that in India, most women, a large percentage of women might be using the phone, but a very small percentage of women actually own their phones. And what this means is that their usage is, their autonomy may not be as high as we think it might be. And that emancipatory narrative, we really need to be a bit more critical about it. Because I think I agree with what you said, Suyash. I think self-help groups and this microfinance movement has been pretty good for certain pockets of women in certain states. And the danger is that actually digital might, if it's not done a little bit more thoughtfully and it just, you kind of rush towards mobile first, you kind of might lose the nuance, and then very quickly you might just entrench some of those power hierarchies when it comes inside a household in terms of who's spending the cash. So I guess that's just to problematize at the level of specific communities. Can we think a little bit more in India, especially this gender, I think is a big kind of issue that as the recovery sets in, we might actually see a polarization and a further exclusion, I suppose, of particular groups. And I suppose the last thing I will say is, when I think about digital right now, previously it was one thing, it was like a payment product, it was a phone, or it was a digital ID. I really think now we need to think about it in terms of infrastructure. And we need to think about, a couple of points in that infrastructure. I think one thing I will say is when these, the big success of the last 6 months obviously has been that our infrastructure has kicked in and allowed, say, welfare disbursements. I think the other big thing that I found out when I was writing a paper back in June is that transaction failures are pretty high. My estimates were about 40%. I think Dalberg has a survey again, or maybe Omidyar. I've seen a few surveys. Azim Premji University is doing an excellent survey. Again, pretty high numbers of failures. And those failures are in Aadhaar-linked accounts. Those are primarily in public sector banks. So actually, we very much have a bank-led financial inclusion model, and the digital there is very much still, unfortunately, not with the private sector. We haven't seen as much innovation as I would have loved to see. Though, the regulatory space has been pretty light in India for the last 4 or 5 years. We always talk about laws coming and that they do arrive, but, it's pretty wide. How can we incentivize that kind of engagement instead of just having these accounts in public sector banks? Who, unfortunately, they have a huge load. Their servers, as Sultan was pointing out, many of the, they have legacy infrastructures and a lot of other issues. And I guess the last thing, just to end on this kind of infrastructure point, is this whole idea of what is this crisis doing to data quality in our financial system is something I really worry about, or actually just think about, because we do have a moratorium, but I'm not quite sure how that's being enforced in terms of, especially low-income groups. Many people have claimed these moratoriums, but it's not really clear about whether that's being reported as a default or not to credit bureaus, to even the people who have credit scoring. I know it's a big point of conversation in the US with the CARES Act, but in India, interestingly, it hasn't really been a point of conversation. So going forward again into our K-shaped recovery, our bad credit score is going to come back to haunt people, in this kind of situation. Is something we really need to think about, I think, on demand and supply side. So that's just kind of 4 or 5 points there. And I'm really keen to hear more from the other experts on the panel.
Thank you. Thank you, Malavika. We just have a few minutes for a discussion and then we'll take a few audience questions. So I'm going to just pose one question each and I request a very brief answer if possible so that we can save some time for audience question also. And my first question is to Dr. Macome. Mozambique is at a stage of financial inclusion where India was early in the last decade. And now it's, you are focusing on thinking about how to deepen financial access in the next few years. And you were also previously in a leadership position in the central bank there. So India took a position which was kind of a hybrid strategy. So there was a state-led program to improve financial access, first dimension only, like get bank accounts open, get payments going. And markets were also working on the side. And there was a certain top-down push also to get it done. What is the strategy that you think will work in Mozambique and other countries in Africa that you're familiar with in making the most of digital finance opportunity, while of course also managing the risk? So what is the role of the state? How much should be left to the markets to figure it out for the next few years?
Thank you for this very important question on how we strategize to bring more people included financially. I think we are in a moment that we do have good things and also things that are under the table of awareness. I will not say bad, but things that we need to think on them critically. One of the things is related to ID. ID is a big question, which in the end of the day is related to QIC aspects. I do believe that a country in this generation that is not working properly to identify, to know who is who in its own space, is in a position to fail to take the benefits of the digital economy, or what the digital transformation is required that each of us have to do in our country. So I think that one is the big challenge that my country has at the moment. And we are working in that direction on how we are having a digital ID, not just a simple ID documents, but to know that I'm using the same identity and I just have different use case in top of my ID. That one will help. It can be seen as part of the infrastructure, and I see the digital ID as a foundation for digital finance, for financial inclusion. It's why I'm starting talking about the identification. We need to know who is who, and it will be easy even for the people working in financial, in fintechs and in other areas, as I was saying, different use cases. The second component in terms of, and here when I'm talking digital ID, we are asking what is the role. I think the first role here will be for the states, for the governments, who has the right to give digital ID is the government. But then the private sector will come in order to facilitate this digital ID and also designing new use cases that can be used in different situations. So even here in the digital ID, I see a role of private sector, but also the main role should be coming for the government. The second component is what Malavika, I don't know if I'm pronouncing very well your name, was talking about the infrastructure. There is no way that we can have digital financial service without a good telecommunication infrastructure, without good infrastructure. So infrastructure is required. And again, I see role in both sides. Because I used to say that financial inclusion we have to see as a public good. And if it's a public good, all of us were called to contribute to that public good. So I see even in the infrastructure, yes, the first role is for the governments, but the private sector has also to contribute in order to make that that infrastructure ready to be used in order to facilitate, I will not say a leapfrog, but to facilitate the acceleration of the process of financial inclusion, because we cannot start going in the same speed that maybe the others have followed. We need to accelerate in somehow, and the technology is forcing us to make this kind of acceleration. But it is also important that the provider, when they produce, the put in provision the service and the product, it's important that they are affordable. We cannot design a product and put in the market, even when they're responding the need of specific target group, but if it's not affordable, and it's not the protection of the consumer of using that product is not there, then we're going to have a problem. So we need to have that one. And here is calling again the role of the governments as a policymaker, but also the role of the regulators. What the regulator is doing in order to facilitate. And here I can share with you an example that we work together with our regulator for banking sector, central bank, in order to establish a sandbox, because our fintech ecosystem is a very new one. When we started talking about fintech some years ago, no one was saying, no, we don't have that one, will not be needed, the banks are enough. But now we start to see fintechs coming, and now the regulator is also called, because unfortunately, in that area, we need to be regulator, we need policymaker, but at the same time, innovation is going a little bit ahead. And the question is, how do you make this marriage, this wedding of regulation and not stopping innovation, and also asking the innovator to innovate in order to make things easy, in order to reach the people in the last mile. So it is a role of different players, innovators, regulator, policymaker, and in the end of the day, also, I used to say that the academia has some things to do here in that space if we want to accelerate our financial inclusion. So in terms of strategy is that, yes, Mozambique has elected digital financial services, one of the means that can help us facilitate, but in order to do that, we need to have infrastructure, we need to have a proper regulation that is healthy and proactive, and the open space where innovator can bring innovative product and solution to those people that are in the last mile. Is what I can say at this stage. Thank you very much.
Thank you, Dr. Macome. Since you are embarking upon a digital identity project, I would just offer one gratuitous advice from India's experience. Please start with the law and make that project under that law. It will be good. Otherwise, who knows what kind of conflict might come out of.
You are right. It is not an easy task. We had a webinar last month about the digital ID, and there was also learning experience from Tanzania. But the High Commission for India has put available that next year we can organize some discussion bringing Indian experience. Who knows, maybe I will contact some of you in order to be in that webinar discussing with us, bringing what is the experience from India, what we can learn before we go to that one. One of the lessons that we need to go first to the law. Thank you very much. Yeah.
Now I'll start weaving in some of the audience questions into my own questions also. So because I think we are now at, we just have enough time for audience questions, and I will not be asking any new questions other than those which our audience are also asking. So the first question is to Shilpa. There is an audience question about what do you think is the most dominant factor that is making last mile inclusion difficult? I mean, I think they want the number one in the list of many last mile challenges, but what do you think is the most important challenge?
Yeah, I think it's ease of access, if you ask me. I think in one line it's that. So, I just want to stress, I know we all talk about it, but for the person at the end of this last mile, going to the bank in the nearest village is losing your day's salary. And I think until we get payment into the person's village or homestead, really inclusion is not complete.
And we still have some way to go before we get that. Many villages, there are customer service points, but it's not universal, right?
Yeah, and maybe if I can just add, Suyash, the fact that, incentives for making that happen sometimes become important because banks' cost structures will not allow banks to go there. The government maybe has, actually, while it wants access to happen, the government can't do it on their own. And therefore, given that we have this infrastructure, how can we get incentives for entrepreneurs to do it? The business correspondent model is working. How do you really take that further down is the question, and how do you incentivize these entrepreneurs?
Thank you. The next question, I mean, it's not directed towards anyone in particular, but I'll ask Malavika to answer this if she would. How should the literacy barrier to digital financial inclusion be dealt with? Do literacy and trust in digital financial payments go hand in hand?
Yeah, great question. And I think, I guess my top two responses to that immediately is that trust is foundational. We see the Mere Mika Internet Trends reports on India last 2 years ago now. It shows that most Indians with a phone are using it for entertainment and messaging. When it comes to finance, there's a sharp drop off. And I think that's because of glitches and kind of technical failures in the infrastructure and the absence of grievance redress that I think Shilpa brought up. So I think if we need to do better and we need to win trust, then that needs to improve. And I think an important factor, I think, in that is actually for regulators and people running the system to start auditing the system and releasing data about that. I think that will raise trust. So, log all your decisions, have some kind of failure rates put out, figure out which providers or which part of the system is actually going down so that you can target your investment there. I think those are some specific things that really need to have started happening already. Just on literacy, I think the kind of literature on this shows that even tertiary level educated students at Stanford or whatever, financial literacy has only always really gone so far. And it's the same thing with data literacy. So if you throw 1,000 pages at people, make them sit in a course, it's not really going to stick. I think a lot of it is that teaching moment between the provider and the consumer. That's where the learning really happened. That's where the decision making is salient. So I think, how do you think about conduct of providers in the practices of finance? Conduct, not even regulation, just like, interface design. All of these things become important. I'm not a big fan of the let's put money in the financial literacy bucket.
Yeah, I mean, we don't talk about medical literacy, and finance is about as complicated as medicine. To get it right, you need some expertise. So, Sultan, I have a question for you. I mean, based on your work at UCOA, so this is a question about how community banks, community-based financial institutions can use digital technologies, digital finance. And what I see out there is the two camps. I'm oversimplifying a little, but just for the sake of framing a question. One is a camp which says that fintech, digital finance is going to disrupt community banking or banking in general later, but community banking first. These faceless institutions are going to come and basically disrupt these business models, which is based on local trust and knowledge and all of that. There's another which says that these technologies will help community banks and local community financial institutions get better. Their systems can become more robust. We don't have to invest in large capital infrastructure because there is, we can use services, software as service, and all of that. You can get better risk management done because they're exposed to a lot of risk because they're localized. Any calamity happens, a financial institution fails. In US, we saw that a lot. Hundreds of community banks fail over. I mean, they're very high, prone to failure. Which camp do you belong to and why?
So it's a great question, and I wish it was as simple as saying A or B, but it's really neither, right? It's that for a long time, financial institutions. Well, here I'll give you C through F. How's that? So for a long time, community financial institutions were terrified of these fintechs, were terrified of the larger institutions, and really saw them as a threat. I don't believe that. Fundamentally, the community financial institutions usually own that last mile discussion significantly better than a bunch of kids sitting in a loft in some big city 1,000 kilometers away, right? The second camp is a little more realistic in terms of partnering between the community financial institutions and the more modern technology players, and they work together to bring interesting and new things to market. And here in the United States, just this year, because of COVID, with the PPP loans, the vast majority of PPP loans in the United States were run and managed by community financial institutions, but the actual execution was in partnership with fintechs. In fact, a couple of fintechs made an incredible fortune this year just doing that. The C through F comment, though, is that there's a gradient here, and the notion that you can paint with a single brush these entire markets is just not a useful way of thinking about it, right? The different feature sets, the different financial services products, the different kinds of plays are going to be there. So if you look at how M-Pesa launched very powerfully, it's because it was a green field. There was nothing really compelling similar to that. And you go to Europe, you look at Revolut or N26, you go to or Venmo, for example, now more globally, or the Starbucks app, frankly, there are billions of dollars sitting in the Starbucks app, and that's not a bank. That's not any sort of regulated financial institution. And so that's your kind of C through F. The fact is these organizations can't exist without the other. And the biggest mechanism for partnering between them is going to come down to fundamentally the consumer adoption on one side and regulatory support on the other side. And so that becomes I think the framing side of the answer, which is much more important. All of these actors need to establish ways to work together. And as we continue to see the decentralization of core financial institutions, instead of having one technology stack, they will have 15. Instead of having one product set or one mobile app, they will have 5 or 10. That will continue, and this more federated model is what I think is what we'll end up with. Different features exist in different parts of the ecosystem, offered by different players, but under a standardized framework. And if we do our jobs right over the next coming years, it will be a multinational set of frameworks, not a unique to one nation, which, by the way, gets back to solving that data localization challenge that I think is the fundamental biggest issue we have right now.
Thank you, Sultan. That was an interesting hypothesis. We could bet on it, and we'll see in a few years how it goes.
I've actually bet on it already, so I'll let you know.
Thank you. We are now out of time, and I would like to thank all my panelists for joining us today. Thank you, Dr. Macome, for sharing your insights about how Mozambique sees the strategy playing out over the next few years. I'm sure India and Mozambique have a lot to learn from each other. Thank you, Shilpa and Malavika, for bringing the voice of the consumers, bringing a certain nuance to the story, especially a certain realism to how this is going to pan out. It's going to be a long process, and there will be mistakes made, and we need to be mindful of those. Thank you, Sultan, for bringing on in the perspective on, I would say, a little tech optimism and lots of possibilities of what can be done. Thank you all for joining me today, and I hope to continue these conversations in the future.
Thank you.
Thank you.
Thank you.